Assalamu alaikum and hello everybody. This is Zeeshan Hasan, a tutor for advanced audit assurance, and in this video, I'll be discussing the question number one of recent past paper June 24 exams. Okay, so let's dive in. Here it is. It is 1st July 2000 X5. Okay, and you are the okay. You are the manager in the audit of Plum and Co., a firm of chartered certified accountants, okay, responsible for the audit of Magenta Group, a listed entity. Remember, it is a listed entity which has a financial year ending 30th September 2005. Uh, we just found out that it is a listed entity. Okay, today is 1st July X5. Remember that dates have a very important role, and it's and the year end is 30th September X5. So 3 months to go. So 3 months to go to the year end, and we are planning the audit for Magenta Group. Nothing as usual. Nothing strange in it. Plum and Co. is responsible for the audit of the group consolidated financial statements. Okay. Financial statements and the individual financial statements of all the group companies. Okay. The following exhibits available on the left hand side of the screen provide information relevant to the question. I just copy pasted like this. So all of these are here. Our first exhibit is partner's email, an email you have received from Violet Purple, the group audit engagement partner. Number two exhibit is related to the background information about the Magenta group operations and activities. Number three, meeting notes from a meetings between Violet Purple Group and the group finance director. Number four, email from group audit committee and email received by the Violet Purple from the chair of the group audit committee, Sean Blue. Okay, Cyan Blue. Now we have the first exhibit over here. Okay, exhibit one. The partner's email to audit manager from Violet Purple, a group engagement audit engagement partner. Okay, it's a group audit engagement partner. Subject is audit planning from the Magenta Group. Date is 1st July X5. Hello. You need to start planning the audit of the Magenta Group, the group for the year ending 30th September 2005. And to help with this, I have provided you with some relevant information. I met with the group finance director yesterday to discuss a number of matters, including some recent developments, business developments. I have also received a concerning email from the audit committee of the group regarding some unusual payments. Okay. Based on the analysis I have done on this industry, it is appropriate for overall materiality to be based on the profitability of the group, as this is a key focus for the group investors and the providers of the finance. Okay. So another thing we found out, materiality need to be calculated on profitability. And if you remember, the benchmark of the profitability is between 5 to 10%. Okay. Using the information in Exhibit 2, 3, and 4, I require you to prepare briefing notes for my own use in which you, number one, evaluate the significant business. Oh, sorry. I have to use the highlighter. Evaluate the business risks to be considered in planning the group audit. 10 marks. That means 10 marks available. That means uh, sorry, 10 divided by 2. That means 5 business risks at maximum. Enough 4 to 5 actually. Okay. Now, number two. Number two, justify why each of the following issues have been identified as a significant risk of material misstatements. Now, he asked for the partner Violet. Yeah, what was the name? Yeah, Violet Purple actually asked for the significant audit risk. He provided you the risk already. You do not need to identify any further. Uh, or you can do so, but these are the essentials which we cannot ignore. So, what are those operating licenses, operating segments, oil and gas extraction platforms? You will need to determine and apply appropriate materiality threshold in your briefing notes 7 14 marks. That means 6 to 7 here will be enough. 6 to 7 auditors enough and appropriate enough. Okay, now the next requirement. Let's see what is this. Nothing as usual in requirement as well. Design the principal audit procedures to be performed on the impairment of the cash operating units for the extraction of oil and gas. 8 marks. 1 mark per procedure. 1 mark per procedure. So at maximum, 8 procedures will be enough. 8 procedures will be enough, but yes, I will give you some extra. Number D, discuss the auditor's responsibilities and describe the impact on planning the audit. Again, 8 marks available here. Now, background information. Oh, what it's saying. The group is one of the world's largest oil and gas companies with activities ranging from oil and gas, sometimes referred to as fossil fuels exploration through extraction and retail. The groups operates globally through wholly owned subsidiaries. Okay, most of the group shareholders are institutional investors, and a high profile investment manager has recently commented on social media that old fashioned oil companies are likely to become less attractive investments as more environmental friendly policies across the world will drive renewable fuel technologies as a condition of providing finance. So we find out our first one. The first point are here in this para. Okay, and what is this? Okay, that what is the business risk here? That if it is not updated to environmental friendly technology or systems, it would impact the business as investors may reluctant to invest, right? That's the point I made over here. Now, exploration. The group has exploration rights across the world, enabling to test for new sources of oil and gas to replace existing sources as they are depleted. The number of viable sites discovered has been reducing year on year. Another issue we got. And what is that? The number of viable sites decreasing. They may struggle to discover oil and gas, and therefore gas extraction may not fulfill demand. No. Extraction, transport, and refining. The group extracts oil and gas through deep sea oil extraction platforms. The oil and gas is then transported via land or sea, either refining into fuel and other products or for sale on the wholesale market. These platforms are used around 40 to 50 years before the depletion of the reserve renders them uneconomic to continue operating. Obsolete oil platforms are generally required by the governments to be decommissioned, a process which can take several years and cost over 500 million per platform. Now, well, why I'm doing it pink? Because it's our audit risk as well as our business risk as well. So I'm just giving it a one color at a time, and it is high decommissioning cost. It will apply IS 16 over here. Okay, and again, obsolete costs might be capitalized. The transportation of fusel is a widely debated issue with environmental groups demanding stricter laws to deal with spillages or leaks. Another issue, okay, and this is our business risk as well. Again, plus audit risk as well. They are demanding stricter laws to deal with spillages or leaks. So it is a currently debated issue. And if companies do not apply rules on it, or some, they might lose the investors in the futures, because you know the investors in the futures, as it can be a bad publicity issue as well. Okay, so moving on, the group, no, not the revenue. The group has made three main revenue streams. The fuel sales division covered diesel. Okay, diesel and aviation fuel sales, along with sales from the retail convenience outlets at the fuel filling stations. The lubricant division products and services to automotives. Okay, industrial, marine, and energy markets, and the wholesale division makes sales to the petrochemical industry for use in products such as packaging, textiles, and building materials. Okay, so here obviously we have it is the issue related to IFRS 15 regarding the revenue recognition. But one more thing, it is an listed entity. It is an listed entity, and it has various divisions. Okay, so we will apply IFRS 8 operating segments as well. We have to check that operating segments are identified and they are applying the IFRS 8 accordingly or not. So this is another point we got. Then we have some points related to renewables. The group operates a new renewables energy division to reflect the growing demand for environmental sustainable energy. The division was created in response to environmental concerns surrounding the risk of climate change resulting from greenhouse gases. Okay. Uh, the group's long-term plans are continue to develop renewable energy sources in order to meet climate change targets set by the government in the country in which the group is headquartered. So, in addition, this division acts protection against the fluctuation in oil and gas wholesale prices. The renewable sales are expected to reach the threshold to be reported as a separate segment of revenue for the first time in financial statement for the year ending 30th September. Again, the issue here is related to IFRS 8 as they are getting new segment. Is it fulfilling the requirement of segment or not? We have to check it. Okay. Then we have to look at the climate related disclosures as well. Okay. Moving on. Now we have exhibit 3. Okay. And in exhibit 3, now the projected group's segmental revenue for 30th September 2000x5. The revenue for the year is 108,276 million. 2000x4 101,567 million. Okay, comprising fuel sales and lubricants 37, 34, 739, 37, 249. So it is decreasing over here. Wholesale 54, 359 and 56, 908. It is increasing. Renewables is now first time reporting separately, and others are decreasing significantly as we can see over here. Okay. So just second. Let me take out my calculator. For fuels and lubricants, it's 37,204 minus 34,739 divided by how much we have to divide? Divided by 37,204. So this year it is decreased by 6.62%. Okay. The wholesale is increasing by 56,908. 54,359. 54,359. So 4.6%. Wholesale increased by 4.6%. It's material definitely 15,254 first time. 15,254,000 material. Others are decreasing already very significantly, but the percentage is 1375. 8629. 8629 divided by 10,004. So it's 0.86%. Very, very significant. Okay. Um, Profit before tax 3,233,000, and now let's look at the materiality as well. They have given us the profit before tax. Let us check if there is anything else. No. So 3233 into 0.05. So it's 161.5. Okay. Next 3103. Oh, 3233 into 10%. 323.3. Okay. That's the benchmarks we calculated. Now, total assets also increasing. How much? Let us check. 82,256. 76, 122, 6134 divided by 76, 122. How much we getting? 0.08. That means 8% almost. It's material as well. Now, let's moving ahead with the question. Uh, Group operating licenses. The group holds oil and gas extraction license for each of its platform. The range in duration from 20 to 50 years. Okay. However, all licenses are amortized over an average of 40 years. Well, on average, guys, they're saying average. It's already something fishy over here. The average, how, uh, okay, the current carrying amount of operating license is 7,200,000. License can be revoked by government if the group fails to operate in accordance with condition attached to the licenses. So there we have issue related to the amortization over here. Okay, we have a issue related to the This includes strict safety procedures and pollution limits of which the group has internal controls in place to enforce and monitor. As part of the terms of the license, the group is required to decommission or remove the platform at the end of its operating life. So decommissioning issue over here, amortization issue over here, and there may be impairment issue over here. Right. Now, oil extraction platform. The group operates 38 offshore oil and gas platform of varying sizes. These are classified as PPE. So here again, it's a cash generating unit. That means these are classified. The total carrying amount of 29,201,000,000. The cost of the platform includes estimated future decommissioning costs discounted to present value at the date the platform is ready to use. Each oil platform is depreciated based on the base of the oil and gas extracted as the proportion of the total expected volumes over the life of the oil platform. Depreciation for the year to 30th September X5 is projected to be 926 million. The group treats each oil platform as CGU. Already, I told you, and performs an annual review of each of the CGUs as an indicators of impairment. So we have impairment issue over here, where an indicator of impairment exists. The group performs an impairment test. Okay. Due to the nature of the oil platform and difficulty obtaining a market value of the sales value of each side. Okay, the impairment test compares the carrying amount of the combined platform components with the value in use. Future revenues are estimated based on long-term oil and gas and price predictions. Costs are based on the average operating and capital costs. Well, this is the wrong treatment over here. Associated with the specific platform after the adjusting for predicted inflation rates. Okay. Uh, we can take the future cash flows, but not the inflation rates. These are then discounted at the group standard discounted rate for 1.5%. Okay. Not full. Estimates are reviewed on the 6 monthly basis, enabling management to have up to date figure for the interim financial statement. The reviews are at 31st March X5, resulting in impairment losses recognized of 350 million. Impairment reversals of 560 million with the net credit recognized within the operating profit. None of the oil platform CGUs has an attributable goodwill. Okay. And finally, the last exhibit, email from Group Audit Committee to Violet Purple from Cyan Blue, Chair of the Magenta Group Audit Committee, subject suspicious payment. Our internal audit department has been performing a review of the acquisitions. Okay. Of the operating licenses and associated costs and brought to my attention a payment made outside of the normal internal control process. The payment of 0.2 million in January X5 was made directly to a politician in another country where the group has been negotiating a new license and its authorization has been tracked back to one of the regional operating directors. This payment appears to have been made just before the politician stopped opposing a new oil platform in the region. Okay. I am concerned this payment may be linked to the granting of the operating license and also that it was possible to bypass our internal controls on payment for licenses. I am also concerned that this was not detected by you as our auditor at the interim audit. I would like to discuss this further at our pre-audit briefing. Thank you, Cyan Blue. That's it. So I hope this is the scenario. Now let us discuss the answers. I already drafted the answer to save the time. Now let us discuss. Firstly, first thing first. First thing first, and what I'm doing. First thing, briefing notes, adding. Now, two, violet purpose, group audit engagement partner from audit manager, subject audit planning in relation to Magenta Group. That's it. That's all. You know, what's that? Copy paste. Control C, Control V. That's it from the question. Now, the next heading, the introductions. These briefing notes have been prepared to assist in planning the audit of the Magenta Group, the group for the year ending 30th September 5. The notes begin with copy paste first requirement. The notes begin with the evaluation of the significant business risk facing the client and the focus on the operating licenses, operating segments, value of operating platform as area of significant risk of material misstatement. The notes also include principal audit procedures which have been designed in respect of the impairment of the gas and oil extraction asset, component of property, plant and equipment. Finally, the notes discuss the email from the chair of the audit committee regarding the unusual payment made to the government official. Okay. Uh, First heading, evaluation of a significant business risk, failure to find new or viable site. I already identified it. The group is dependent in the long term on sourcing new site for the extraction of oil and gas. And there is a risk that group fails to obtain the rights to test for new sources of oil and gas, or that their exploration rights do not identify viable sources. With changing policies by many countries leading to governments refusing to permit right for further exploration with respect to fuels, finding new sites will be even more difficult. This would lead to reduction in the group's ability to extract and sell its key product. So there is a risk that also the risk that costs incurred to purchase exploration rights and to explore for new sources exceed the revenue generated by the resources found. So that means revenue will be lower and the cost will be higher and it can be the loss making in the future. Okay, 2 marks. That's it. Next, operating license is our business risk as well. And the group depends on operating license to enable extraction to occur. This is a risk that government will not award such license to the group, especially considering growing environmental pressure. Remember, we just identified the factor with, in the question while reading and planning the questions, right? So there is also a risk that licenses which have been purchase may be withdrawn if the group fails to adhere to the strict conditions and attached to them. As significant costs are incurred in the construction of oil platform, there is a risk that these costs must be written off if the platform can no longer be used to the withdrawal on an operating license. This would have a significant impact on the group ability to generate revenue and profit. Extraction, health and safety. Okay. The extraction and transportation of oil and gas is dangerous and very strict. Health and safety procedures are required to operate in the industry. So there is a risk that these procedures may be breached or insufficient, which could result in accidents involving injury to workers or damage of assets. A breach of safety procedures may result in bad publicity, legal costs, significant repair costs, and potentially loss of operating license. Additionally, it may be the case that one or more oil platforms would require improvements to prevent further occurrences and may not be available for use until complete, further compounding the loss of revenue. Further, litigation and bad publicity from pollution incidents, there is a risk accidents and spillages may occur. We already identified it. When transporting extracted fuels, leading to environmental damage, this may result in additional bad publicity, leading to reputational damage, Such events may also result in fines being levied by, sorry, regulatory bodies in the relevant jurisdictions, which would have a significant impact on the group profit and cash flow. Cleanup costs are also likely to be highly significant. Should this happen, any resulting reputational damage may also deter future investment from banks or institutional investors as they come under increasing pressure to restrict investments in companies responsible for pollution and climate damage. Decreasing demand for fossil fuels. Many governments are committed to reducing the consumption of fossil fuels such as oil and gas, which will cause a long-term fall in demand for the group core product. There has been 6.6% fall in revenue. We identified it while looking at the meeting exhibit 3. Fall in revenue from fuel and lubricants from 2004 to 5, which could be evidence for this trend. First, the revenue from fuel and lubricants represent 32.1%. Now it's 36 points of total revenue. Second, the revenue from the wholesale businesses represent 52.6%, while in X4, it was 53.5%. The total revenue decreased sales of fossil fuels, the significant part of business as a result. It is likely that long-term decrease in value of oil may mean existing oil platforms become unviable to run, decreasing the value of the group's asset and reducing the scale on which it operates. So far, so good. Decommissioning cost increase. The group is responsible for decommissioning of oil platform once they are at the end of the life. The costs are very large and will place a significant drain on the group cash flows as they occur. As the lifespan of the asset is very long, there is not a uncertainty regarding the cost to dismantle and remove them, as this may be up to 50 years in the future. So it may be the case that actual costs are very different from those originally budgeted and provided for. So we are done with the business risk, right? 1, 2, 3, 4, and 5. So that's how we can score easily. Oh, sorry. Yeah, easily we can score 8 to 10 marks from this requirement if we do like this. I hope it's clear till here. Now, the next requirement, justification of identified risk of material misstatement. For the purpose of this briefing note, the following materiality level will be used to assess the significant or identified risk as the requested has been based on the profitability of the group. We just a while ago read in the scenario that it should be based on the profitability. The benchmarks is between 5 to 10%. I told you the profit before tax gives a range of 323 million, 162 to 323 million. Remember, I told you that it is 5%, it is 10%. So the group is listed, yes, and there are large area of subjectivity, for example, estimation of decommissioning costs, uncertainties regarding the long-term viability of sites and potential pressures. As a result, financial result for the year. Therefore, the group has been considered a high audit risk, and such lower benchmark of 162 million will be used for materiality. Okay. So operating licenses. The operating licenses which provide extraction rights are recognized as intangible assets with a carrying amount of 7,210,000, which is material to the financial statements. Okay. 7,210 million. Okay. Amortization is appropriate. That licenses are amortized as they have a finite life. As they have a yeah, they have a finite life. However, the period over which they are amortized may not be appropriate. The government policy to amortize over an average of 40 years. I told you it is not appropriate. Okay. But the actual period to which the rights relate varies from 20 to 50 years. Therefore, it may be appropriate to use an average for the basis of an accounting policy. It means that some rights are being amortized over too long a period, overstating intangible assets and understating expenses. Now, the next thing is impairment. There is an additional risk that operating licenses may be impaired, giving the global drive to reduce dependence on fossil fuels. This potentially reduced demand for fossil fuels could lead to the early closure of extraction platforms or potential revocation if any license conditions are not met. Should this be the case, there is a further risk of overstated assets giving the pressure to demonstrate profits are sustainable despite climate control initiatives. Management has an incentive to reduce costs, such as amortization, to remain attractive to institutional investors. The high materiality of the value of the licenses, combined with the potential estimation risk arising due to the group's amortization policy, as well as the uncertainties in long-term demand for fossil fuels, means this issue carries a high inherent risk. Cool enough. Now, operating segments. As a group is listed entity, okay, it is required to disclose information in notes to the financial statements according with the IFRS 8 operating segments. A segment is a component of an entity. See what I'm doing first. I'm just like explaining the part of the standard IFRS 8. Right. So a segment is a component of an entity whose operating results are reviewed regularly by entities chief operating decision maker to make decisions about resources to be allocated to the segment and assess its performance. Companies are required to report segments which comprise over 10% of the entity's revenue, profits, or assets. There is a risk of material misstatement that the disclosure may be inaccurate or incomplete, or that it does not reflect the way information on the financial performance is monitored internally by chief operating decision maker. So it is required by IFRS 8. This risk is increased, giving the pressure on the group to show a strong growth in renewables as a result of investor pressure, and this could result in misclassification of further revenue to the renewables operating segment. Renewables represent 14.1% of the projected revenue for the year ending 30th September X1. It is unclear of sales in 2000 X4 related to renewables, as this was not reported in prior years. So this is based on the projected revenue percentage. Okay, total projected revenue. Okay, therefore it is difficult to assess the reasonableness of the figure, and there is a risk that this figure is overstated. Comparatives will need to be restated as a result of the change in operating segment identified separately this year. Hence, there is also a risk that appropriate disclosures are omitted from the financial statements. The external pressures for management bias combined with the sustainability of these disclosures with respect to bias means this risk is significant, and given the focus of investors and finance providers on renewables, the area is likely to be qualitatively material. Next thing, oil platform depreciation. Oil platform assets are material to statement of financial position as they exceed the threshold set for the audits. According to the IS 16, property, plant, and equipment, the depreciable amount, cost less residual value, should be allocated on a systematic basis over the asset's useful life. Depreciation method. You should reflect the pattern in which the asset's economic benefits are consumed by the entity, hence charging depreciation based on the proportion of oil and gas reserves. Extractive of the total amount is appropriate. This calculation, however, is more complex than straight line or reducing balance, as total amount expected to be extracted from a site is a matter of judgment requiring expert assessment. Management judgment in this area increases the inherent risk associated with the depreciation calculation. Finally, it is likely that the long-term oil and gas price fluctuate. The amounts of oil and gas which can economically be extracted from a given site may change. The group should review this estimates at least annually. And if the pattern of consumption of benefits has changed, the depreciation method should be changed prospectively. Should be changed prospectively. Now onwards, that means as a change in estimate, future expected future reduction in selling prices could be indicative of a higher rate of the consumption of the future economic benefits embedded in the oil platform. If the estimates of the oil reserve or the predictions of long-term prices are inaccurate, then the depreciation charge will be incorrect, causing overstatement, understatement of property, plant, and equipment, and operating profit. As a result, management may be reluctant to increase depreciation if required, if they are under pressure to meet the profit expectations of the market. Oil platforms impairment. The group appears to following the requirement of IAS 36. State the asset should be assessed for indicators of impairment each reporting period. At the end of each reporting period, an impairment test performed where there is an indication of impairment. The impairment loss recognized for the 6 months to 31st March X5 of 350 million is material. Yes, the impairment reversal of 560 million and the effect of the impairment reversals at 210 million are also material. Each platform is treated as separate cash generating unit CGU by the group, and asset is impaired by the carrying amount of the asset is higher than the recoverable amount. The recoverable amount is the higher of the fair value less cost to sell and value in use of asset. Where the assets in a CGU are impaired, the impair is first written off against the any obviously impairment as impaired assets to no lower than their individual recoverable amount, then prorate across the remaining assets of the cash generating unit. So the calculation of the recoverable amount for the oil platform is complex one, right? With a high number of estimates, particularly to assess value in use, which is based on estimates for future expected cash flows to be derived from the CGU. It also involves estimates of the long-term oil and gas prices, which are very volatile. The cost of operating the platform for a lengthy period in the future and the use of the discount factors, incorporating the risk specific to each platform, given that the group uses a single discount rate for all impairment calculation. It is possible that the rate used in the inappropriate for some locations where the political and economic profile should give rise to different cost of capital. There is therefore a risk that estimates used are inappropriate, resulting in an over or understatement of impairment expense. And to corresponding asset value of the CGU, this would be an area where management may be biased in making estimates which are favorable to reported profit figures, and as a result, this area should be approached with a high degree of skepticism. So IS 36 permits the also permits the reversal of impairment losses, but only where there has been a change in estimate used to determine the asset's recoverable amount since the loss was recognized. So in addition, the reversal cannot give rise to carrying amount higher than what the depreciated historical cost of the asset would be. Such reversals are generally recognized through the statement of profit or loss, or for the period there is a risk that reversal use the CGU value in use amount and that this may be greater than the asset depreciated historical cost, resulting in an overstatement of assets and profits. Now, operating segments. As the group is a listed entity, it will be required to disclose information in the notes to the financial statements according to the IFRS 8. A segment is a component of the entity whose operating results are reviewed regularly by the entity chief entity decision maker to make decisions about resources to be allocated to the segment and assess its performance. Companies are required to report segments which comprise over 10% of the entity's revenue, profit, or asset. There is a risk of material misstatement that the disclosures may be inaccurate or incomplete, or it does not reflect the way information on financial performance is monitored internally by chief operating decision maker as required by IFRS 8. So this risk is increased, giving the pressure on the group to show a strong growth in renewables as a result of investor pressure, and this could result in misclassification of other revenue to the renewables operating segment. Renewable represent 14.1% of the projected revenue for the year ending 30th September X5. It is unclear what portion of sales in X4 related to the renewables, as this was not reported in the prior year. Therefore, it is difficult to assess the reasonableness of this figure, and there is a risk that this figure is overstated. Comparatives will need to be restated as a result of the change in operating segment identified separately this year. Hence, there is also a risk that appropriate disclosures are omitted from the financial statements. The external pressure for the management bias combined with the susceptibility of these disclosures with respect to bias means the risk is significant, and given the focus of investors and finance providers on renewables, the area is likely to be qualitatively material. Cool. Now, oil platform depreciation. Oil platforms assets are material to the statement of financial position as they exceed the threshold set for the audit according to IS 16. Property, plant, and equipment. The depreciable amount less cost less residual value should be allocated on a systematic basis over the asset useful life. The depreciation method used should reflect the pattern in which the asset's economic benefits are consumed by the entity. Hence, charging depreciation based on the proportion of the oil and gas reserves extracted of the total expected amount is appropriate. So this calculation, however, is more complex than straight line or reducing balance method, as the total amount expected to be extracted from a site is a matter of judgment requiring expert assessment. Management judgment in this area increases the inherent risk associated with the depreciable or depreciation calculation. It is likely long-term oil and gas prices fluctuate. The amount of oil gas which can economically be extracted from given site may change. The group should review this estimate at least annually, and pattern of consumption of benefits has changed. The depreciation method should be changed prospectively, as a change in estimate expected future reduction in selling price could be indicative of higher rate of consumption. The future economic benefits embedded in the oil platform. If the estimates of reserves or the predictions of long-term prices are inaccurate, then the depreciation charge will be incorrect, causing overstatement or understatement of property, plant, and equipment and operating profit as a result. Management may be reluctant to increase depreciation if required if they are under pressure to meet the profit expectations of the market. The oil platforms impairment. The group appears to be following the requirements of IS 36 which states the asset should be assessed, indicator of impairment. Okay, we already done that. Sorry. Oil platforms decommissioning costs. According to IS 37 provisions, contingent liabilities and assets, a provision should be recognized if there is a present obligation as a result of past event and that there is a risk probable of future economic benefits for which a reliable estimate can be made. In this case, there is a legal obligation to decommissioning the platforms according to the IS 37. The expected cost of decommissioning the platform would require provision for decommissioning. The value of the expected removal cost with the amount added to the cost of the asset. The cost of the decommissioning are likely to be high and across all extraction platforms. This is likely to be material. The figure is highly judgmental and therefore carries a high inherent risk. IS 37 requires that discount factor used is the pre-tax discount rate, reflecting the current market assessment of the time value of money. As risk specific to the liability, the unwinding of the discount would be charged as a financing cost to the statement of profit or loss. Each year, there is a risk that the group estimates are not appropriate given the long-term nature of the obligation. This would lead to an understatement of property, plant, and equipment assets in the course of construction and understatement of long-term liabilities. In addition, there is a risk that discount factor used when calculating the present value of the decommissioning cost is not appropriate. This may result in either an over or an understatement of the liability and the finance cost. It is unclear that if the group rate of 1.5% used for the impairment calculation has been applied to the decommissioning provision, and this may not reflect the specific risk attributable to each individual decommissioning allocation location, there will be different economic and political risks arising in different locations, potentially resulting in different cost of capital. Okay, further, there is a risk that provision of demarcationing of the group extraction platforms has been reviewed during the year to change in any of the estimates. Example, discount rates or future costs could give rise to a material misstatement of provision. The risk is also where management could use changes in the estimate to boost its profits through the release of the provisions, increase in discount rate used, or reduction in estimated costs. Given the amount of asset which would require a provision for decommissioning, any errors made in the assumptions relating to the decommissioning of platforms could be material in aggregate. So far, so good. We are done with the two requirements. Now we have the next requirement, that is audit procedures in relation to the respect of impairment of oil and gas platforms. First procedure will be review the controls in place over preparation of the impairment reviews, including the sources of information used and task controls to ensure they are operating effectively. Next, review the impairment indicator analysis prepared by the management and assess whether the analysis is consistent with the auditor's understanding of the group and industry. Okay. From the non-current asset register, confirm the Carrying amount of the cash generating unit prior to any impairment being recognized and confirmed. The carrying amount of each component of the CGU. Discuss with management the difficulties in measuring fair value less cost of disposal to confirm the basis recoverable amount on value in use is acceptable and accordance with IS 36. Obtain the client schedule calculating in value in use and discuss the basis of calculation with management, assessing the reasonable of the key assumptions. Use, for example, the effects of the climate change on demand and price for long-term gas. Sorry. For long-term gas and oil prices, compare the assumptions against market data and industry forecasts to support the assumptions used in management calculations. Review the discount factor used in the impairment reviews and ensure the specific risk in relation to each cash generating unit are factored into the discount factor. Compare operating costs for a sample of CGUs to historical operating costs to confirm they are complete and realistic. Compare future capital expenditure with cash flow forecast for CGUs to capital expenditure forecast. Compare management historical forecasting accuracy to actual results to assess management's capability in producing forecasts and ensure estimates have been prepared. Confirm the basis on which impairment confirm the basis on which impairment reversals have been recognized to ensure that there has been an increase in the service potential of the relevant oil and gas platform. Review impairment reversal journals to ensure asset carrying amounts do not exceed depreciated historical costs. So far, so good. 3 requirements done. Now the final one. Auditor's responsibilities in relation to matters arising from the email of from the audit committee and the impact on planning the audit. The unusual payment referred in the email from the group audit committee may be bribed to a government official in order to facilitate granting of an exceptional license in that country. In many countries, payment of this nature are illegal, and it's possible that the group has performed an illegal act. The auditor is required by ISA 315 revised, identifying and assessing the risk of material misstatement to gain an understanding of the legal and regulatory framework in which the audit entity operates. This will help the auditor to identify non-compliance and assess the implications of non-compliance. The auditor also need to consider the requirement of ISA 250 consideration of laws and regulations in an audit of financial statements. ISA 250 states, while it is management responsibility to ensure that the entity's operations are conducted in accordance with the provisions of laws and regulations, the auditor does have some responsibility in relation to the compliance with the laws and regulations, especially where non-compliance has an impact on the financial statements. ISA 250 requires that when non-compliance is identified or suspected, the auditor shall obtain an understanding of the nature of the act and the circumstances in which it has occurred, further information to evaluate possible effect on the financial statement. Therefore, procedures should be planned to obtain evidence regarding the impairment. ISA 250 requires the matter to be discussed with management and where appropriate with those charged with governance. The auditor should attempt to find out where the payment was approved at the high level or whether the director was acting in isolation. The auditor should also consider whether this is a one-off event or whether there is evidence of further instances. So, as per the chair of the audit committee brought by the matter to our attention, it is unlikely that the audit committee had knowledge of such practices, and we may be able to utilize some of the internal audit investigations results to aid our understanding. There is also an issue in that the situation potentially indicates a lack of integrity of the operations director and may indicate a wider issue in terms of the region covered by the director or even more widely within the group where we have doubts regarding management integrity within a client. We will be less able to place reliance on representations from the management and will need to plan extended audit procedures accordingly. The override of controls which take place with this transaction may also indicate that we need to release control risk, although it is encouraging that internal audit committee have detected this instance. The failure of interim audit procedures to identify the transaction referred to by chair of the audit committee is likely to be due to the combination of factors. If the incident is isolated, then the payment is immaterial. It is not possible for auditor to test every transaction. And in this case, the override of the group's controls by a director would mean that normal controls testing would not have highlighted a weakness in the controls over the operation license payments. In terms of in terms of reporting non-compliance to the relevant regulatory authorities, ISA 250 requires auditors to determine whether they have the responsibility to report the identified or suspected non-compliance to parties include outside the entity in the event that management or those charged with governance of the group fail to make the necessary disclosure to the regulatory authorities. The auditor should consider whether they should make the disclosure. This will depend on matters including whether there is a legal duty to disclose or whether it is considered to be in the public interest to do so. Confidentially, it is also an issue if disclosures were to be made by the auditor. It would be advisable to seek legal advice on the matter. Further advice on the disclosure in the public interest is given by the Code of Ethics for Professional Accountants in the section giving specific guidance on responding to non-compliance with laws and regulations. The guidance gives examples of situations where disclosures might be appropriate. These examples include reference to an entity being involved in the bribery and the breaches of regulations, which might impact adversely on public health and safety. The code also clarifies in exceptional circumstances where the auditor believes there may be an imminent breach of law or regulation. They may need to disclose the matter immediately. The disclosure to disclose will always be matter of the auditor's judgment where the disclosure is made in good faith. It will not constitute a breach of duty of confidentiality. Okay. The auditor may also consider taking legal advice to understand the implications of any particular course of action. Or the audit plan must also ensure that the whole process of the complying with laws and regulations guidance, including the course of action considered, the judgments made, and the decisions taken are adequately documented. So far, so good. We are done with the question number one. I hope you get it, how to draft the answer and how to take out the points from the questions. We are done with the question one. Question two, we'll do very soon, right? So this is it for now. Take care and bye-bye.